Welcome to the daily stock review of Dell. Goal of this channel is to uncover the world's best stocks that have 100x potential by reviewing 1,000 stocks in 12 months. If that sounds good, subscribe to come along. Who am I? I'm Jack. I'm an individual investor on the journey. I'm just 2,500 hours in over the last 7 years and sharing the lessons along the way. Here's my investing process. It's got 5 steps. Where to look, 5-minute check today on pretty much how I came across this business and is this business worth looking into further? These are the guys I learned off. They did pretty well for themselves over just a little while. By following the breadcrumbs that they've left behind, we'll be able to follow in their footsteps. If you'd like the investing resources I wish I had when I first started, they're free. Link in the description. Let's get into it. So Dell, how to come across it? There's been a fair bit of hype, and I came across it just through news. So going back from February this year of around $115 a share, it's now hovering just under $500 a share. So it's definitely 4x for some people that would have purchased back down here. Now, what's going on? So that's how I came across it. Now I want to go through the actual business and do this 5-minute check. Looking for the annual report, and as I looked through it, I just saw and took note of this Form 4, which in the US is a statement of changes in beneficial ownership of securities. So all that means is you can click on this form, you can have a look at it. It is formatted terribly for people that have never seen one before, but in short, it usually comes up and says who it is. So it's this business, which sometimes it's a business, sometimes it's a person, but at this stage it's a director and it's a 10% owner. It comes up with what they're doing, and then it also has a code. So A is acquired, D is disposed. So if they sold the stock, it's a D. And so this has had 89,000 shares. They've sold them. And then it says it's held through this. So we can see that there's a lot of selling. It's got, I guess, a little total here. It's got a couple of footnotes. Ugh, formatting's terrible. And then it goes through this and just gives you a little rundown. But from this, we can see there's a fair bit of selling going on from insiders, just from the fact that that takes up the whole page. There's some more. There's a Form 144, which is prior to intended sale of restricted stock as well. So that's just, it's not a, rats leaving the ship. There's lots of reasons. Those guys may have held on to their own Dell stocks for, a decade or more. And they've been waiting for the best time to liquidate that cash and take a couple of chips off the table. They might need to give money back to their other shareholders if they've been another funder or something like that. Or if it's personal, they just do whatever with it. Buy a new house, pay the mortgage off, etc. All right, so what I'm looking for is the financial statements. Oh yeah. So I want to have a look at the income. I like to see revenue growing in most of the businesses that I'm looking at. So I can see that revenue growth in products. Apologies, guys. Revenue growth is pretty strong. 64. That's in millions. So millions and then billions. So 64 billion, 71 billion, and 90 billion. So it's got some consistent growth year on year. Services has stayed fairly flat, if anything. Cost of products. So the cost of the products is very high. So it's not a very high margin part of the business. What have they done in the services area? It stayed fairly constant. If anything, it's decreased a little bit, but it also decreased a little bit in the services for that year. So it's not making a lot of money relative to the cost of its goods. Considering they've only made, they spent 90 billion, they get to keep 12. So pretty much for every, if you had 9 fingers, you've spent 9 of them and you get $1 back. So that's not a high margin part of the business. Whereas the services business, they sold 23, they're getting to keep 12, which is half. All right. So just take a note of that at this stage. Got our gross margin there, which the majority of it's come from this part of the business, which is from the services so far. Which is interesting. Total cost of net revenue. Awesome. So coming a bit further down, has the business had to increase selling general and admin to achieve that gain? No. Looks like their customers are coming to them. Research and development, has that increased? Nope. And total operating expenses has stayed pretty flat. So all this gain on these products and the increase there is purely pretty much coming straight through the business and hitting the bottom line, which is our net income from 3.3 to 4.5 to 5.9. So this is the reason why we don't just write off a business when we see that it doesn't have, if the low margin part of the business is growing, we don't just write it off, because here we can see a business that appears to be quite well run. Costs inside the business haven't grown at all, and all it's doing is just selling more products, collecting cash. And due to it being well run operationally, it's able to turn any of that growth into money, which is a really good sign. So that's mastery. It looks like it's mastered its customer, at least for the moment, just with Dell being computer based and the AI boom that we're seeing at the moment. Potentially that a lot of their products are being utilized in that subset. All right, we just want to have a look here and just make sure the business isn't loaded up with debt and it's going to go and explode on us. So total assets of 100 billion. Total liabilities of pretty much the same, 100 billion. Long-term debt is 23 billion. Has grown a little bit, with the majority of this being accounts payable, which varies from year to year. What have they got to actually prop themselves up? Well, total current assets comes to 57, which is pretty reasonable. And what do they got for current liabilities? 63. So it's pretty much evenly balanced in terms of assets and liabilities. Obviously, like to see a business with a much more tidier balance sheet, but that's where it's at the moment. Now let's have a look at these cash flows. So the business, its net income comes out the top. Our cash, or changing cash from operating activities, where are we? Why is it written like that? It's really annoying. All right, so cash from operating activities is this whole section. It comes out and just goes change in cash from operating activities. Ooh, I'm hoping that's the start of our free cash flow number. Why it's worded like that, it's really annoying. And it's why, even with this kind of a standardized accounting system through most areas, it's still annoying. Going from each one of these financial statements is slightly different. All right, so we're getting some cash flow come out. It is pretty lumpy. It's what we'd expect. We've got pretty significant accounts payable coming back in here. Accounts receivable coming out, pretty much cancelling that out. Where's the money being spent in the business? We've got purchases, maturities, and capital expenses, capitalised software development costs. Oh, nice. So this one's got majority of it all together. You can see that that number's pretty consistent throughout. So it's most likely just going to be the maintenance capital expenses, not actually putting efforts into growing the business. And so there's still a substantial amount of cash left over. We've got 8.5 billion, 4.5 billion, and 11 billion across those years. They're only spending $2.6 billion worth. So where's the rest of this cash going? It's got repurchases of common stock, which it's been doing consistently. And it's got payment of dividends and dividend equivalents. So it's paying a dividend routinely. So some of the cash is going out to investors. And then it's got repayments of debt. So this is one that I don't really like. You can see here that if you combined repurchases of common stock and repayments of dividends, 7.5 versus repayments of debt is $8.5 billion. And I guess proceeds from debt come back into it as well. So over time, all they've been doing is just balancing it. But it's one of those things that majority of that, like, you want to be focused on providing as much shareholder value, and the balance sheet is pretty loaded up. You want to make sure you've got a pretty good differential between assets and liabilities. Make sure the business is covering its ass for as many different scenarios that can happen in the future. And Dell's probably been priced like that in the past, which is why the stock price was a bit lower than it probably should have been. All right. So do I think this business is worth looking into further? So Dell's definitely a large and established company. It's been around for a very long time. It's been around longer than 2016, so going back to 1994. Is it worth looking into? Do I think it's going to 100x, or it's got somewhere close to that kind of potential? I don't think so. Pardon me. The business at the moment is showing growth in areas that the business doesn't have to, put any effort into growing, which is great. But it's a matter of how long is that going to last, and is it based on is it based on a moat from the business? I don't think so. I think the services part of the business, it does have high margins versus its product division probably being closer to a commoditized service based on the actual margins they're able to make from it. Now, if that changes because they have a starving audience and people can't get enough of the products that they need to build out whatever they're building, then that may be a reason that they have sustained growth for a while. And it's a matter of analyzing, is that growth going to continue, and is it going to be sustainable and slow down, or is it going to go with a rapid increase and then demand completely drop off and pop? So that is part of the deep dive that you would need to do if you were looking at this business further. Now, is it really worth the hype around it? I'd think so. And how can I say that and say that I'm not going to look into it further? I'm looking for businesses that are going to be growing consistently at those kind of rates for quite a while. Dell, for this stage, it does have a price to earnings ratio of 36, which is probably fairly reasonable for the growth rate that it's seeing and the amount of money that's hitting the bottom line in terms of its net income. So the other things are, if this business does start to increase its margins on those products and service, or the products part of the business, that would indicate a really good sign. But at this stage, it's been consistent year over year. So it makes me think that they're more commoditized and you can get them from wherever, whenever. All right. That's my take on Dell. I think it is worth the hype. I think the stock price hasn't been accurately reflected for quite a while. So if you'd purchase back here, you'd probably be well compensated for the value that the business is providing. If you like this, check out this next video because YouTube reckons you'll like it. Cheers.